In 2021, ProPublica obtained leaked IRS data on the 25 wealthiest Americans. Here is what they found. Jeff Bezos, $0 in federal income taxes, 2007-2011. Elon Musk, effective tax rate of 3.27%. Michael Bloomberg, 1.3%. You, working a job, running a small business, grinding, probably paid somewhere between 22 and 37%. Let that land. They have more. They keep more. And the system making that possible? It has your signature on it, every April 15th, like clockwork. This isn't a conspiracy theory. This is published tax law. This is the U.S. tax code, all 4 million words of it, working exactly as it was designed to work. The question is, designed for whom? Before we go further, I need to tell you about a strategy called buy, borrow, die. 3 words, legal, IRS approved. And it is the single most elegant wealth preservation mechanism ever constructed in American tax history. I'm going to break it down in full, the mechanics, the math, the exit strategy, later in this video. But first, you need to understand why it exists, because it didn't appear by accident. It exists because the tax code is not a set of rules. It is an operating system. And like any operating system, it has 2 types of users. Those who run the software, and those the software runs on. Let me show you how the machine actually works. The U.S. tax code taxes behavior, not just income, behavior. When you work for money, a salary, hourly wages, a W-2, the government treats that as ordinary income. Top rate, 37%. Add state taxes in California or New York. You're looking at 50 cents of every dollar gone before you touch it. That is the tax code's way of saying, we don't reward labor. But when money works for you, through investments, through assets, through capital, the tax rate drops to 20%, sometimes lower, sometimes 0. The code rewards ownership, not effort. Here's the second layer. The middle class, not the poor, not the ultra-rich. The middle class is the primary fuel source of the federal revenue engine. In 2022, the top 1% paid roughly 40% of all federal income taxes. Sounds like they're paying their share, right? That's the talking point. But here's what they don't tell you. That 1% controls 32% of all U.S. wealth, and the majority of their gains are never realized as taxable income at all. They borrow against assets. They defer. They step up. They restructure. The middle class earns income. The wealthy engineer it. This is not broken. This is working as designed. Now, the critical question nobody is asking. If the code was written by lobbyists, passed by Congress, and signed into law, who hired those lobbyists? Follow the money, it always answers. Let me challenge something you've been told your whole life. Tax avoidance is wrong. You've heard this. Maybe you've said it. Let me be direct with you. That belief is costing you money every single year. Tax evasion, hiding income, falsifying records, fraud, that is illegal. That is a federal crime. We are not talking about that. Tax avoidance, using every legal provision, deduction, and structure the code explicitly offers, is not only legal, it is the intended function of the tax code. The IRS says so, the courts say so, the architects of the code say so. Anyone may arrange his affairs so that his taxes shall be as low as possible. He is not bound to choose that pattern which best pays the treasury. There is not even a patriotic duty to increase one's taxes. Judge Learned Hand, U.S. Court of Appeals, 1947. Read that twice. The tax code is a map of government incentives. Every deduction, every credit, every depreciation schedule is the government saying, we want you to do this. And when you don't use those provisions, you are not being virtuous. You are not being patriotic. You are choosing to pay a voluntary penalty for being uninformed. The wealthy didn't rig the game. They simply learned to read the map. The question is whether you're going to keep wandering or start navigating. Mechanism 1. Carried interest. Reclassifying labor as capital. You work, you get paid. Your income is taxed as ordinary income. A hedge fund manager works. They get paid. Their income is taxed at the capital gains rate, 20%. Same human effort, different IRS classification. How? The mechanism is called carried interest. Here's how it works. A private equity manager raises a $500 million fund. They charge two things: a management fee, typically 2%, taxed as ordinary income, and a performance fee called the carry, typically 20% of profits. The carry, which is compensation for managing money, making decisions, doing a job, is structured as a partnership profit interest. Under current law, it is treated as long-term capital gains, not ordinary income. The result? A fund manager earning $10 million in carry pays the same tax rate as someone who passively held stock. This has been federal law since the Tax Reform Act of 1986. It has survived bipartisan congressional debate for nearly 4 decades. Because the people debating it are often invested in the same funds benefiting from it. That is not commentary. That is a documented fact. Mechanism 2, stepped-up basis, the ultimate reset button. This is the mechanism that makes generational wealth truly dynastic. Here is how asset taxation normally works. You buy stock at $10. It grows to $100. You sell. You owe capital gains tax on the $90 profit. That's your basis. But here's what happens when you die instead of sell. Under current IRS law, Section 1014, when you pass an asset to your heirs, the cost basis is stepped up to the fair market value at the time of your death. Your heir inherits the stock at $100. They sell it at $100. Zero capital gains tax. On $90 of real wealth-building appreciation, that gain, built over decades, is permanently erased from the tax ledger. Now apply this to a family that never sells. They hold real estate, equities, private business interests. Generation after generation, those assets step up, resetting the tax clock indefinitely. The unrealized gains of the wealthiest Americans are estimated in the trillions of dollars. Gains that, under current law, may never be taxed. Not because they cheated, because they understood Section 1014 and held. The strategy is simple. Don't realize gains. Borrow against the asset instead. Loans are not taxable income. When you die, the asset steps up, the loan is repaid from the estate, and the gain disappears. That is buy, borrow, die. In full. Legal. Documented. Being used right now by every major dynastic family in America. Mechanism 3. Depreciation. How paper losses fund. This one is where the game gets truly asymmetric. The IRS allows real estate owners to deduct the wear and tear of a physical property over time. Residential properties depreciate over 27.5 years. Commercial over 39 years. You deduct a portion of the building's value every single year as a paper loss. The building isn't actually deteriorating. In most markets, it's appreciating. But the IRS doesn't care. You take the deduction anyway. Now add cost segregation. Instead of depreciating the whole building slowly, you hire an engineering firm to classify components separately: flooring, fixtures, landscaping, electrical systems, and accelerate the depreciation on those components over 5, 7, or 15 years instead of 27.5. The result, a $3 million property might generate $800,000 in paper losses in year 1 alone. Add Section 179 and bonus depreciation provisions under the Tax Cuts and Jobs Act, and certain qualifying assets can be 100% expensed in the year of purchase. Positive cash flow. Zero taxable income. The property is generating real money. The paper says it's losing. The IRS accepts the paper. This is not a loophole. This is the intended design. The government wants capital deployed into housing. Depreciation is the incentive. The wealthy don't earn money and then pay taxes on it. They build assets that generate cash, manufacture losses on paper, and let the code foot the bill. I'm not going to tell you the system is fair. It isn't. I'm not going to tell you this is how it should be. Maybe it shouldn't. But here is what I know with absolute certainty. The rules exist. They apply to you, and you can use them. The difference between the family that builds a dynasty and the one that grinds for 40 years and hands most of it to the treasury is not intelligence. It is not luck. It is financial literacy as a competitive weapon. The wealthy treat the tax code the way a general treats a battlefield map. They find the high ground. They exploit the terrain. They don't complain about the landscape. They dominate it. The middle class was taught to be a good soldier. Show up, work hard, file your W-2, trust the system. Nobody teaches you that the system has a back door. Sovereignty over your financial life begins with one decision: to stop treating the tax code as a set of obligations and start treating it as a set of instructions. Carry interest says, structure your compensation as ownership. Stepped up basis says, hold, don't sell, borrow, pass it down. Depreciation says, own the real assets. Make the paper work for you. These are not loopholes. They are the map. Written by the wealthy, available to anyone willing to read it. The last page is blank, because your chapter hasn't been written. Here's what I want you to do. Not like and subscribe. Not drop a comment. I want you to open a new note on your phone right now and write 3 words. Own, borrow, inherit. That is the dynasty model in 3 words. That is the operating system the top 0.1% runs on. This channel, Zero to Dynasty, exists for one reason: to make that operating system available to you. No gatekeeping, no watered-down advice, no corporate hedging. If you want to go deeper, the next video in this series breaks down exactly how to use a solo 401k and a real estate LLC in combination to legally shelter 6 figures of income starting this tax year. Not next decade, this year. The inner circle doesn't wait for permission, neither should you.